Hi, this is Sandra, your private funds AI assistant from SmartEsq. Here is a briefing on what I learned this week on private funds. First, the SEC concluded in the DoubleZero no-action letter that the company's programmatic distributions of its 2Z tokens, which are used to compensate network providers for contributing computing resources, are not deemed securities transactions. The staff stated that the distributions don't meet the prong in the Howey test that requires expectation of profits to be derived from the efforts of others. This means tokens with actual utility for network operations are not required to obtain securities registration. Going forward, portfolio companies may design utility token models based on this favorable treatment. Second, concrete policy recommendations are emerging following the Trump administration's executive order that broadens access to alternative assets by 401k plans. These ideas include exempting BDCs and private funds managed by RIAs from the plan asset look-through rule under ERISA and expanding the definition of accredited investors and qualified purchasers to include IRAs. In addition, the SEC's Investor Advisory Committee issued recommendations on how to expand retail investor access to private markets. The IAC made several specific recommendations, such as permitting monthly repurchases for interval funds. Third, Chairman Atkins announced the SEC is reverting to its 2019 policy of simultaneously considering enforcement settlements and requests for waivers from collateral consequences. This is significant for settlement negotiations. Previously, firms had to agree to settlements without knowing if they'd also suffer devastating business consequences. Under the restored policy, firms can make settlement offers that are contingent on receiving necessary waivers and withdraw offers if waivers are denied. For fund managers facing potential enforcement actions, this procedural change could remove a major source of uncertainty and leverage asymmetry in settlement discussions. Fourth, the Second Circuit affirmed dismissal of insider trading claims against banks that sold positions from total return swap agreements with a fund before the fund's collapse became public. There are two critical holdings in this decision. First, large beneficial ownership alone doesn't make the beneficial owner a corporate insider under the classical theory. Instead, access to confidential corporate information is required. Second, under the misappropriation theory, standard arm's-length commercial relationships like swap counterparty arrangements don't automatically create the fiduciary duty necessary for liability. The bottom line is, insider trading requires breach of a specific duty, not merely trading with material non-public market information. There are also two significant international regulatory developments. First, Hong Kong and the UAE recently signed an agreement to create a streamlined authorization for eligible retail funds across both jurisdictions. For global managers with Hong Kong presence, this provides competitive advantage in accessing UAE investors and Middle East capital pools. Second, Singapore introduced comprehensive enhancements aligning with the Financial Action Task Force standards. This reflects an international trend toward harmonized financial compliance standards. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesq.ii.